Hello, this is Habina. Today we will be auditing the Warehouse Group. Part 1. Audit and Planning. The Warehouse Group operates discount retail department store, selling a broad range of non-glossary and glossary products. It is the largest retail group operating in New Zealand. It is listed in the New Zealand Exchange since 1994. So, what does the Warehouse Group do? There are 6 major subsidiaries under the Warehouse Group. The first one, the Warehouse. The Warehouse sells items of essential use like sport and gardening equipment. The Warehouse Stationery sells computer and office product. 777, as well as One Day, are retailers online. No Limit is a retailer of electronics product. The market is an e-commerce shopping platform similar to Amazon. As we can see, the Warehouse Group are running retail business both online and offline. So, why should the Warehouse Group get audited? There are 3 reasons: compliance, benefit of being audited, and to those who may consent. Let's look at them in detail. Firstly, it is required by law. Under the Financial Market Conduct Act 2013, it states that issuers listed in the exchange market need to be audited. Also, under Company Act 1993, it emphasized that companies required by FMC need to be audited. The second reason of audit is that audit does bring benefit to entity. Firstly, this provides invaluable credibility to users of the audit report that financially everything is as it is. Second, detect and prevent fraud. Audit can point out weaknesses in organization system and controls, and suggesting ways to strengthen them to prevent fraud. Third, price protection. Being audited can avoid the price protection of the creditors to further reduce the cost of capitals. How does the relevant shareholder use the audit report? The stakeholders want to know if the business is running in accordance with the information they are given. Employers cares if they can get paid on time. Potential investors of the Warehouse Group will have a knowledge of ongoing profitability based on the audit report. Creditors, for example bank, care about the credibility and reliability of the business. They want to know whether the capital value of their loan is secure. Customers want to know quality of product, post-sale service. The Warehouse Group faces a broad range of risks as a retailer within New Zealand. There are 2 types of risk: inherent risk and control risk. Let's have a look at inherent risk. Inventory valuation. Inventory are easy to get damaged in the warehouse due to the warehouse storage problem. Second, assets are susceptible to theft, especially cash on hand is by nature more susceptible to theft than inventory. 3. State of the economy. When there's a downtime in the economy, will the Warehouse Group be able to survive? For example, lockdown due to COVID-19. Will the Warehouse Group be able to survive, repay their upcoming debts, maintain their employees, and restore their operation right after the lockdown is over? There are 3 control risks of the Warehouse Group. The first one is damage of goods in transit. Inventory are easy to get damaged during transit, and those damaged goods need to be removed from the inventory evaluation at the end of the counting period. This risk can be reduced by physical observation. Second, due to the high volume of inventory, warehouses are often at high risk of burglary and theft, especially if inventory is high value. Therefore, the physical observation and camera can be implemented to reduce this. Obsolete 3. Obsolete inventory. Some inventory is especially easier to depreciation, for example, the electronic devices in No Limit. Therefore, the value of those inventory need to be recalculated more regularly. Inherent risk, for example, state of economy. Warehouse still providing buy online and collect during level 3 of lockdown. The impact of COVID-19 on warehouse is not as great as on the tourism industry, for example, Air New Zealand. For control risk, we can identify the efficiency of internal control to see whether the internal control will address the control risk. we can see there are securities and a lot of camera in the shop. Therefore, we can consider that control risk is relatively low. Overall, we consider risk of material misstatement of the warehouse group to be somewhere between low and medium. Part 2. Audit Programming. The account we'll be looked at here is inventory. From balance sheet, we can see the value of inventory takes 77.8 of total current asset and around half of the total asset. Under the note of inventory, we can see inventory is made up by goods in transit from overseas and retail stock. Therefore, risks we talked in previous slides, such as inventory valuation, obsolescence of inventory, and the risk of damaged goods in transit is significant. From balance sheet, we know that inventory is taking a significant portion of total asset. And under the note of inventory, we know that the risk that we talked in previous slides, such as inventory valuation and the risk of damaged goods in transit, is significant. The risk is considered to be somewhere between low and medium. Therefore, we consider the current internal control is reliable and do test of control, which does not cost as much as substantive procedure. To obtain the assertion of valuation and location, we will have two procedures: reperform the calculation to see if the calculation is in accordance with the accounting policies. Second, physical observation. We can use the physical observation to see if there are default inventory sitting in the warehouse. Procedure 1. Reperforming. We can check the calculation and the reconciliation. We can take some of the transaction from the warehouse group and run the calculation again to see if they are according with the control policies. We assure that there is no default goods and record under the inventory, and due to the obsolescence, some value of the goods need to be recalculated. Procedure 2. Physical observation. Audit can check whether there is a default goods sitting in the warehouse and count the number of inventory to obtain the physical evidence of the allocation and valuation. Therefore, the warehouse group is a low risk of material misstatement company with internal control. Auditors can plan to test those internal control to further adjust the effectiveness of the controls.